We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Vince Lanci, founder of Echo Bay Partners and publisher of Goldfix Substack. How are you today, Vince?
Good, Tom. Thanks for having me on.
Excellent to have you back. And of course, we're recording this the day after, coincidentally, we did a Twitter Spaces together. So we might have a little bit of a continuation on a couple of those topics here. But, you know, you recently wrote an article showing that JP Morgan and Citibank are now 90% of the US gold derivatives market because of an accounting change. JP Morgan's derivative exposure, for example, has grown by over 1,000% in the first quarter of this year. We've spoken before about the Basel III regulations. So does this have any relationship to that?
Oh, it totally does. And I think you know that, but I appreciate you being a gentleman about it. This all started with our first conversation. You know, the first time I was on, it was you brought together Keith and Bob and myself and you had
Adrian.
Oh, and Adrian
Day as well.
Right, because we couldn't get him back. Right, exactly. Adrian, I think he had to leave early, and Adrian Day, and we had a nice little group of people there that really had a handle from different perspectives on Basel III. So to answer your first question, yes, it's in my opinion directly related to the changes that came about in Europe as a result of Basel III. But before we continue, I want to thank you for hosting the spaces we did yesterday. And of course, I want to apologize because I goofed and double booked. So thank you for doing this today as opposed to yesterday. Thanks.
Not a problem. Always happy to be flexible. So why is there this sudden change in how they're holding these derivatives now, over this first quarter?
I don't know why they picked this date to do it, but they definitely picked a date to do it. And you can connect any dots you want, but I think the dots go back to Basel III. And by that, I mean, increasingly regulatory agencies are creating a unified regulatory page that they're all on. And so they may be slightly different in their variations where they put their levels or their numbers, but they have to have the same concepts. So if Basel III comes along and says gold is a tier 1 asset, which is what it did, that's saying that gold is however you want to look at it. It's either money or it's a cash commodity, and however you want to look at it. So I'm going to choose to look at it as money, and by doing that, they deleveraged gold futures in Europe. So you had to have your cash in hand for gold, and so that changes the balance sheet structure for these banks over there. But banks are global now. So if you're a bank in Europe, and this is conjecture, it's informed, but I'm not 100% on anything. But if you're JP Morgan, let's say, or any bank, I'm not trying to single them out, and you're operating in Europe at a certain structure, and you're operating in the US at a different structure, well, there's like a regulatory imperfection there, and you're going to arbitrage. Why would I own gold in London when I can own it in the US? Because I can own it in the US on leverage. So basically you end up creating an imbalance globally. And the London to US relationship for Western gold these days is very important. So the US, to your question, to your point, why so soon, or why so suddenly, I should say, I'm sure they've been talking about it for years. And I'm also sure that they decided to do it because of, more or less, they had intended to do it because of the changes in Basel III to make the banking equal. Maybe the Russian war, maybe the sanctions, maybe those were the final catalyst that made us pull the trigger. But I think the reason is because gold is being, at the central banking level, officially remonetized. And they had to do it at some point.
Mm-hmm. And that's actually a point I'd like to get to a little bit later about the idea of monetizing gold. But, Vince, what do you think the risk to these banks could be if gold really starts trading the other way? When we think of derivatives and leverage, how could that play against them if they have these massive positions here?
Well, you're referring directly to the JP Morgan Citibank and the whole increase. Well, and from a risk perspective, their risk hasn't changed. It's just gone from one bucket to another. It's kind of like, it is what it is. The risk in the bank is the same, but the risk to regulators is different now. The risk to regulators go, this asset class may have too many derivatives, but the bank is fine. So I would have to say that the banks are no worse than they were a month ago. How bad are the banks? I don't know. How bad do I personally feel the banks are? Not bad. Because of Basel III and the events preceding it, the gold dealer market shrunk. You went from 5 to 4, and now essentially in the dealing market, the market makers, the bullion dealers, you have 2 or 3 that actually are very active. And the governments in general, and especially the US, are very comfortable herding risk into one big bucket. So too big to fail is an example of that. Banks started to fail. And so they're like, JP Morgan, you have a good balance sheet. We'll loan you money. You go buy that bank out. You go buy that bank out. And that's kind of what they did. I mean, not quid pro quo, but that's kind of what they did. So while the government, I can imagine a government saying, whoa, look at all these derivatives. And so they changed these specs. They changed the amount of money you have to have on hand to trade them. And so the smaller banks that use maybe gold as a loss leader or an ancillary product, they start to drop out. It's like a low-cost production. And the banks that remain end up sucking in all the derivatives. So the liquidity remains and it gets concentrated. So my first answer would be, I don't think the risk to those banks changes much. I think the risk to whoever's on the other side of those positions changes significantly. And it's not to say that a bank can't be run in by having a position go against them. It's to say that JP Morgan and Citibank are too important. And in light of what happened in nickel, which you alluded to yesterday, in light of what happened at the LME in general, I think they really have their eye on that now. And the government will do whatever it has to protect those 2 or 3 banks. So I don't think there's a lot of risk to the banks on that asset alone. However, I want to add this footnote. However, JP Morgan has other asset classes that it may have problems on. If you look at JP Morgan as a proxy, as the American version of Deutsche Bank has very big systemic risk. Now, if Deutsche Bank has systemic risk, then JP Morgan has systemic risk. Maybe mortgage-backed securities start to go under and JP Morgan has a problem, and that takes the eye off of gold, and then you have this gold thing happen. So the answer is there could be a problem, but it would not shut a bank down. Something else would do that though.
But it could be, a lineup in a string of dominoes. Is that possible?
Oh, and that will be the next paragraph to say that it will be a problem. Mm-hmm. It won't be a problem for the bank. Mm-hmm. And there's domino. The domino will either it'll roll uphill and they'll be bailed out by a government, or they will find someone to get short. And I don't mean that conspiratorially. They will find someone to lay their risk off. Instead of just being one bank having. One of the points I made was you can't have 90% market share in an asset and feel that you're running a good business, and yet they do, and yet it continues, and yet they're allowed. And so why is that? Because the government is comfortable with making an exception to them. But at some point, the government may say, maybe not the government, but the bank may say, dude, 90% is too much. Let's get it down to 50%. And whoever takes the other side of those trades saying, well, I'll take that for 20% discount. It's kind of like the movie margin call. Be first, be better or cheap. Well, it's probably all 3 of those for the bigger banks. To answer your question, a domino effect could definitely happen. Mm-hmm. Similar to behaviorally what happened when Buffett cornered silver. The banks were caught short, except for a couple banks. And then the banks found someone to sell them silver. And that was the producers. And the domino went to the producers. And the producers laid off their risk to the locals in the ring and small hedge funds. And before you know it, the dominoes fell. Dominoes a really good analogy. Yes.
Mm-hmm. So Vince, let's go back to that point that you had made earlier. How is gold different than most commodities? I discussed this with Keith Wiener basically yesterday, and you had some commentary you wanted to add. And maybe we can tie in another point to this after that. But like, how do you view gold as being different than most commodities?
Oh yeah, that's. I just read Keith's content from that report, and I agree with him. And this is going to be rare. We probably have different opinions on many areas, but I agree with him 100% on that. And when people take task with him saying that as he's being negative on the asset, they're wrong. So the concept basically is, and you actually wanted to get into this yesterday, and we touched on it. Is gold is, I'm paraphrasing Keith here, right? Gold is not like other commodities. Gold is not consumed. Therefore, it has no business being backwardated for a long period of time. Copper and oil are produced to be consumed. The production gets ahead. Okay, fine. Gold is different because it is not consumed, which is what you said. Mm-hmm. Gold has been accumulated for millennia. Right. Okay. So you said a lot of other things about that, but those two phrases, what you just said in the second one, are key. All right. So to add to what he's saying, I would have to talk about money historically without sounding too much like a monetary anthropologist. So I'll talk about it like a trader because I was on this. This happened to me. I learned what he said the hard way. So first of all, when he says gold is not consumed and it's been around for millennia, what he's saying, just to restate it in different words, is that all the gold that's ever been mined is in existence. It's not destroyed. It might be a little bit parochial, but I think it's important to get, that's where I'm coming from. It's not destroyed. It's not irretrievable. It's almost not used at all industrially. And because of that, and I say this with love, and I've actually written about this, it's useless. And because it's useless, it's perfect for money. As a store of value is even more special. But what that means is because gold is neither destroyed and its creation or mining can be reasonably calculated as to how quickly it'll come out of the earth, you actually have an asset that is never is a strong word to use, but I'll use it, on occasion, that is never, in quotes, going to be in short demand. Now, that's the academic statement, and it certainly is true if gold were fully monetized, which it is not yet, but gold is partially monetized. So if it's okay with you, maybe explaining why gold is money and why money doesn't, why don't we just say this? If for this conversation, for this part of the conversation, I want to say that gold is money. For this part, 100% money. So I want people to think of it that way. Gold is money and nothing else. Just think of it, the JP Morgan statement. Gold is money and nothing else. Forget about the exchanges, forget about London versus New York. Just pretend that gold is what is used for money in the world. You give me a coin, I give you some grams of gold, whatever, it's money. There's no brand, it's just money. Okay, so money, you can think about this in terms of gold or in terms of dollar bills or Canadian dollars or loons, whatever have you. Money is about, everything in money is about present value versus future value. So I owe you $5 and you say, I want my $5. And I say, I don't have it. And you say, I need to be paid for you paying me back a month later. And that's interest, right?
The cost of borrowing that money.
Right, exactly. But I'm going to call it interest because you're right. It's the cost of borrowing that money, which means that money is the only thing that you pay in kind. So interest or the cost of borrowing money is the money that you've given me, I'm using in some other way, presumably to create wealth, right? And you say, well, Vince, I want interest on that money. I want to be paid for using that money. Well, I'll wash your car. And you say, no, I want money, right? I want money. So you say to me, I want $6 in a month. And so because of that, because that money is present value versus future value, $5 now loaned to me by you is worth $6 a month from now. That's the deal that we have. We just cut a deal. I'm like, fine, I'll pay you $6 a month. Fine. All right. That's our deal, right? And that's the reason money, dollars, currency, don't ever, 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 I actually think I mean that, go backwardated. And the reason for it is if this is spot, and the difference between spot and here's the $5, right? And here's the $6 today and 30 days from now. Well, how do we get this to go up? Well, there is no way to get this to go up, because if you say to me, if I say I don't have it, you say, well, fine, then you're going to pay me $8 2 months from now. And so the whole thing goes up. And so the only thing that you can pay someone in money is money. So it's just using paper. It's just paper. What are we going to use it for? You can't, there is no practical use for money. It's money. And so if you want to be paid with money on money that's loaned, then it doesn't go back. I need these dollars physically right now. Why? Well, silver certificates, right? Here's a silver certificate. Boom. That's different. That's not money. They're different. It's not money. Okay. So that's why money can, I know someone will find an exception, can never, ever, ever go backward. Paper money, fiat. And there's a good reason for that. If you want to express backwardation in money, that's what the bond market is for. The money is always like this. The bond market, interest rates for the next 30 days, you may say to me, Vince, I need that money in 30 days. $6 not enough, pay me $8. So the 30-day bond goes like this. The yield goes like that. And I'm like, oh, I'm screwed, but I got to do it. And I say to you, well, suppose I borrow for 8 months. You're like, dude, I'm not lending it for 8 months. And there's the bond market, and I'm kind of stuck. So the backwardation in money is reflected in interest rates, which are in the bond market. And that, incidentally, sidebar, that's why gold has been on the bond desks and the currency desks forever, which is a legitimate, in quotes, reason for gold being off the JP Morgan balance sheet book. So now we go to gold, right? So now we're in the gold area. So if gold is money and I owe you an ounce of gold and you say I need to be paid, I'm like, well, and that's the only money now. It's the only money, right? I say, I'll wash your car. You say, no, I want the ounce of gold. I say, well, I can't pay it to you. You say, well, Vince, pay me making a ridiculous interest. You pay me 1.5 ounces in a month. And I go, well, that's high. I say, well, that's what I want. So what do? I have to go borrow gold from someone else, right? Can it be backwardated? No, because ultimately it's money. And if you're going to be paying me in kind with more gold, then that curve will eventually, in an extreme situation, be contango out to how quickly it takes to get gold out of the ground. How quickly can we get gold? There's someone in the world, gold is money, and it's perfectly electronically traded. There's someone in the world who has gold. It's like, Vince, I'll lend it to you. And that's kind of what happens in short squeezes. People stop lending. You can't have a short squeeze in gold because gold is money. So at the central banking level, gold is money. They lend each other gold. They lend each other promises to repay gold or substitute, which is in their fiat. And so gold should not, and I'll give you the practical example of this, where I got my ass handed to me trading, thinking it would happen. But Heath's point, gold is not consumed. It exists. It's useless in a loving way. And because of that, it can't backwardate because it's always going to be there. It's not going to be destroyed, the old Goldfinger thing and what have you. So until, I think it was Peter Bernstein who said, until we find a broad industrial use for gold, it's money. And unless we were to use it like we use silver, it won't go backwardated for extended periods of time. If you want, I can get into the example because it's kind of funny. The gold example and backwardation.
Sure.
It's up to you. I had a relationship with the head of Goldman Sachs's Commodity Index trading. And the relationship was basically, he was a mentor. And I was on the floor trading options, and he would run the desk. And I was a new guy, but I had some abilities and I had some reputation. And I would educate him on options. Not that he needed it, he was smarter than me. And he would educate me on the flow of futures. And in the options pit, the gold options went backwardated. The gold options went backwardated, so inverted, right? The volatility in front was lower than the volatility deferred. And so I, clever guy that I am, said, well, if that's going to happen, then the gold future should go backwardated. So I went out and sold tons of spreads and bought prompt, sold, bought. So I was short spreads, expecting backwardation. I speculated outside of my skill set. And a month goes by, actually not a month, a couple of weeks go by, and I call up, I go, hey, Joe, the vol curve is backwardated here. Gold's going to go backwardated. He's like, and this is how he would talk to me. He's like, no, you moron. It's money. It can't go backwardated. And he said to me, we won't let it. Because if a country wants to buy gold that badly from a central bank, it won't go backwardated. We will find that gold and lend it to them and destroy them. You'll destroy a whole economy that way. So I went, oh. So, I had another idea. I was like, I'll do it in silver, but that ended up being another thing. Anyway, so the spreads killed me, and he explained it to me in the way that he does. And after 3 conversations, I got to be on the right page. I'm like, well, what do you mean gold's money? Gold's not money. I would say to him, gold's not money. This is like after me buying him 2 dinners. Gold's not money. I mean, you get paid in money. He's like, yeah, well, he goes, maybe and this is where it comes in the whole bifurcation. Gold may not be money for you, because you're not allowed to buy a ham and cheese sandwich with gold. But at the central bank and international trade level, gold is money. And so we don't let the plebes use it as money. He was joking, but he was being right. Because we don't let the plebes use it as money, but it is money. And that's why we will never let it go backwardated. If it goes backwardated in the futures markets, we'll shut them down. So that I got killed because I had the stupid spread thing on. And you're just sitting there in the markets. It was like the day before expiration. It's like, Vince, do you want to take delivery of 100, contracts of gold? And I'm like, no. Well, then you've got to get out. And so when I got out of it, I locked in like a massive loss. I was like, Joe, what happened? And that's it.
So, Vince, do you believe that in some ways gold is in the process of being remonetized?
Yes. The empirical evidence to that effect is Basel III took gold from a tier 3 asset, which meant that if you had gold on your balance sheet, you had to have, and you wanted to use it as collateral, you only got, let's say, 50 cents on the dollar for it, which is like, put at the same category as art, collateral. And now it's tier 1, which means it's cash. So that means it's 100% fungible for cash. So if you're long gold and you need to borrow money from your central bank, you could say, I'm using my gold for collateral, and they'll give you $1, which incidentally, when gold wasn't in this process, that's one of the reasons it was easier to be short gold. I'm long a bar of gold. They only give me 50 cents to the dollar at the Fed window. Well, crap, I'll just short it, and I'll buy a bond with that money, which gives me 100 cents on the dollar. I'll take the bond and give it to the bank, central bank, and say, give me cash. Now I've got the cash. You can't get all your cash for gold in the past, but that is changing. So Basel III is a big line in the sand or a changing point. And this recategorization under the radar, but caught by a lot of smart gold guys. I think Wall Street Parade wrote something on it as well, which is very odd because they do financial stuff mostly. I think gold is being remonetized. We can say that gold is being remonetized actively, attempting to be by Russia and soon to be China if they have their way. On the other hand, we won't say that it's remonetized until it's already done. So the answer is yes.
But, you're saying they're not going to say that it's remonetized until it's already done. What are some clues that you can point to that are, telegraphing that?
Some clues that it will be remonetized, or some clues that it is being remonetized?
That it is being remonetized. Like, for example, we saw Russia open a window where they were tying, I believe it was 5,000 rubles per gram or per ounce of gold.
Yeah,
I can't remember the exact example.
Yeah.
To their domestic producers. I think that's closed now. It wasn't exactly exchangeable, but are those some examples of gold being remonetized?
Yeah. Yes. The first 2 examples that we've talked about are Basel III. That's a remonetization at the central banking level and the banking level, which encourages them to hold more gold and encourages lesser financial people to not hold gold because they have to have more cash to own it at the bank level. The second thing is this derivative recategorizing. I think it's very important, and although it doesn't directly look like it has to do with monetization, I believe it does. But to your point about, for example, the Russian ruble, I don't know. So I'm going to be just speaking as, between speculation and conjecture. But I would say if I had to look at it from like 1,000 feet above, Russia is trying to do a soft launch on a yuan, even though they're not China, a gold-backed yuan. And without getting too complicated or too down the rabbit hole, it would seem that if gold were fully money, and you brought this up before we went on the air, if gold were fully money, using Russia as an example, then you'd be able to exchange it. It's not fully money. You can't fully exchange it. You can pay in gold. They can tell you that they have gold in the vault, right? But you can't exchange your rubles for gold. That means they've remonetized gold fully. So it's not fully remonetized. I feel it's like a partial attempt to remonetize it. They want to see how it goes. Other examples of monetization would be, actually, frankly, the backwardation in gold right now from spot to front month is raising an eyebrow, by my eyebrow anyway, because it's lasting a little bit longer than I think it should. Now, I'm sure people who are more familiar with it than me, like Keith, will say, well, it's lasted for weeks or months or what have you. But not under these circumstances. So I think there's something going on, whether it be demand for gold as coins, whether it be demand by a sovereign fund at the physical level or a central bank, I don't know. But with all the confluence of events that have gone around it, the backwardation that we have now is not because of the usual, suspects. It seems to be something more significant, which would be, I would say, on my radar as a potential sign of more remonetization. So that's it. I think there's enough out there. Like, for example, silver, big premiums in silver, even bigger premiums than they should be. We all, at some level, we all think, but that's not because it's being remonetized. So you want to say, well, it's, but it is being remonetized slowly. That's, so central banks don't own it, but at the street level, it's the poor man's gold. It's money. Anyway, so hope that helps.
Mm-hmm. So, Vince, with the advent of the BRICS Plus kind of telegraphing to the markets that they might be interested in using a basket of currencies and or commodities, is that another example of the way that the world could be heading, as bringing back gold as an important piece of a trading mechanism?
Well, so I don't want to spend like 10 minutes talking about Zoltan and how much of a fan I am, but the reality is the concept of, and he labeled it, so we'll call it what he calls it. The concept of Bretton Woods 3, or what the BRICS are trying to do, is they want more value to be recognized for their natural resources as a contribution to the global economy. So we have, call it financial skill. We take that oil and we make gasoline. The gasoline powers machines, and the machines create more economic wealth, et cetera, right? But so the world kind of looks at it like it's an Exeter's pyramid, where gold is at the very bottom. And by down there at the bottom with gold, you should put, in the BRICS mind, put natural resources, right? But that's where they get their wealth from. And they want that to be more recognized in the scheme of things. And it is the base of all financial leverage. So what they want to do is, and I think what COVID might have pulled the veil back on, is how dependent the West has become on the East's commodities. And so the East said, I'm making it up, right? The East said, oh, look at this. They really do need our commodities. Let's go on strike. So the countries that make commodities effectively are on strike. We put them on strike with sanctions, but that's a concept. And so they're basically saying, we want to be paid more for commodities, for our. And how do you pay a country more for commodities? Well, not just by paying them for it. It's by saying we want commodities, natural resource commodities that we use, natural gas, oil, to be included in the currency market. So that would be, before the whole Bretton Woods 3 concept, that would be, let's include natural gas and oil in an SDR. And why? Because much of the wealth created in Russia is from oil. So it's not all about manufacturing. Wealth should be created by oil. And China can make the same case. So they start with natural resources because energy is money. And that's actually going to support gold in a second. Energy is money. And by withdrawing energy or by going on strike, you can show how dependent the West can be that way. And so they say Bretton Woods 3, the IMF says, well, we'll talk, they're going to start talking about it. An SDR with natural resources in the basket, and that's not easy to do. But what is easy to do is to use a commodity that's not consumed, that is a product of energy, and can be represented as a ratio of the other commodities, and that's gold. Mm-hmm. So to answer your question, the BRICS are drawing attention to, number one, our natural resources are not compensated for enough in the global economy as a function of our currencies. Number two, we want global currencies to have a component of physical commodities in them, oil and natural gas. Number three, let's face it, it's easier to agree on gold than it is to agree on regional commodities that could go bad or be fraudulently conveyed. So they're saying, getting to your point, they're saying on some level, gold has to be remonetized for global trade. Maybe not necessarily for us to go buy our ham sandwich, but on global trade, it has to be remonetized. Mm-hmm. So yeah, it's a big deal. It's a huge deal. I can't believe I didn't talk about it. Yeah,
yeah, there's so many different pieces to kind of be paying attention to. And I think, Vince, one of the other, big pieces of news that we should talk about, especially this week, of course, we are speaking on the morning of Thursday, July 14th, and we saw that bombshell number of CPI print of 9.1% come out yesterday. So this seemed over almost every big institution's prediction. So how do you see the path forward for the Fed amidst, the destruction in the markets that we've already seen? Do continuing higher prints like this just give them more cover to keep being hawkish with monetary policy?
Yeah. I like to talk about things from 1,000 feet up, but you really, and I will do that, but we really have to put some sort of a deadline or a price level on it. And what's the percentage that people are agreeing that they think that's going to get to that you mentioned before? 3.5? The Fed funds rate of 3.5. Yeah.
Right. So if you want to put a fine point on it, I believe that the Fed will continue raising until something breaks, which is how it always works. And I think the Fed will continue raising until something breaks, but they're much better at hiding what breaks than in the past. So now they have their banks, the too big to fail lesson from the great financial crisis. They have the RRP fund, which is another conversation altogether, which is like an emergency cash stash. They have all these things. So when you look at the path, the Fed will, number one, raise until something breaks. We'll define breaks. Well, a company going under in high profile, Bear Stearns. I don't think that'll happen in the US because they're probably really ahead of it behind the scenes. Number two, a stock market that craters. Yes, I think that's something they would do. How would they do it? I don't know, but they would do it. So that's the definition of what breaks. So what does that mean in terms of a target? Well, you alluded to, you mentioned, I think the consensus is they get rates of 3.5%. So let's say they get rates 3.5%. Whether you think that's enough or not, I don't think it's enough. But if they get it to enough, if they were to get it to enough tomorrow, we would have a Great Depression. We would just have everything will collapse, and that would be a problem. So quantitatively, I think to start quantitatively, we've gone from pricing in 2 50 basis point hikes next to pricing in a 75 and a 50. And now we're almost pricing in, after the CPI you mentioned yesterday, now we're pricing in almost a full 1 percentage point for our next hike, which a Fed speaker will or has already come out saying that's not going to happen. So, and I noticed one of them said it, more than one will say it, but so the CPI comes out 9.1, the market swoons, and people start talking about the short-term interest rate curves, start pricing in a 1% hike by the Fed in July. And so the stock market comes in lower again. And so a Fed speaker comes out and says, no way, we're not doing 1%. And I think he said that because stocks got close to their level. So I may not know what company's going to break. I may not know what industry is going to break, but today, probably maybe tomorrow for your listeners, I don't know, but today, over the next couple of days after this 9.1, you are probably going to see Fed people come out and say, it's okay, we'll stop it in one way or another. So we might be near a breaking point now in terms of speed. They may not care if it goes to 3,500, the S&P. They just don't want it to go there in 5 minutes, which brings us to the 3.5% number. Can they get the 3.5%? Yeah, but you could also get the 3.5% while you're quantitatively easing. You can raise rates and quantitatively ease, which, by the way, is what Europe will eventually do to save Italy from everything else. So the Fed could be putting their foot on the brake, which is raising rates, and simultaneously saying, no, we're not going to do QT, we'll start doing QE. And you're basically pressing both at the same time. And that will be eventually what they have to get to. And the evidence of that analogy is right now the short-term interest rate curve was peaking at 3.5% in Q4 of 22, and in Q1 of 23, it had us lowering rates. So it's kind of like we're raising rates, and the moment we're done raising rates, we're lowering them. Well, then why raise them at all? So maybe 3.5% is 3% if we crash. Maybe it's 4% if we don't. So I think the Fed is in a what do you call it? The horns of a dilemma. Are they going to choose inflation over recession? I have a very definite answer to that, and it's 1,000-foot view if you want to hear it. It'll take 2 seconds.
Yeah, absolutely.
Okay. I think most of the people that I think are involved in our neck of the woods believe that the Fed is a political instrument, politicized instrument. And I'll give you a timeline, and it's going to make sense. Whether it's true or not, we don't know, but it's been making more and more sense. When Biden announced that he was going to reappoint Powell, soon thereafter, or simultaneously, Powell said transitory was an error. We're going to fight inflation. In my world, not quid pro quo, but in my world, Biden said, inflation is now in the headlines. My polls are going to zero. You had better start fighting inflation. And so Powell said, we'll fight inflation. Now, in the back of Powell's mind, he's probably also saying, because he's not a dumb guy, he's also saying, I'll keep fighting inflation, but there's a good chance I can crack it. I can crack the market. And so he's doing his best. And I believe between now and November, which are the midterms, as long as inflation is in the headlines and Biden's, or the Democrats is saying in general, the Democrats' approval ratings are dropping, then Powell raises. So in that sense, I want you to think of Powell as looking at Biden as the bad cop. Biden's the bad cop. I've got to raise rates. But as soon as the real data comes out saying you can't lie about it anymore, it's a recession. If the press starts taking the word recession and putting it in headlines, and Biden's approval ratings go down more, then Biden's going to say, you got to back off. So I believe that if I were genuinely empathetic with Powell, he wants to continue to fight inflation, to do his best, and try not to break anything come November. And then after November, if he still has his job, which is possibly not going to happen, after November, then he's going to be able to do what he wants to do. So to answer your question, do they get the 3.5%? Indirectly your question, I don't know, but I think that's the path. And the path is they raise until they break something. The definition of break is a number in the S&P we haven't thought of, or a very high level company going out of business. Until that happens, it's going to be sell every rally.
And what do you think about the jobs market, for example? Could that cause unemployment numbers could cause him to pivot as well?
The answer is no. The answer is, I'm going to give you a straightforward answer. No. And I say that because of the reading that I've done by Zoltan and stuff like that. And basically, until they change, right? It's no until it's yes. But they're going to tolerate, I'm making a number up. They're going to tolerate 5% unemployment. Why? Because inflation is the mandate. So what I mean by that is to paraphrase what Posar said is we have too many people. It sounds too political. We are going to sacrifice asset prices to get inflation under control, which is what's happening now. We're also going to sacrifice our extremely high employment level at 3.3, 3.4, and we'll let that suffer a little bit to get inflation under control. Our priorities are price stability, and that means we need to get inflation under control. If some people lose jobs because of it, then unfortunately, so be it. So if you see as an active trader, you see, employment comes out higher, that's the Fed. The Fed will then have to fight a recession. I say to you, no. They don't give a damn about it. I mean, they can't afford to care about employment until they get inflation to a respectable level. What that level is, I don't know. But unemployment's on the chopping block right now. They'll make it go up.
Excellent, Vince. You had a great tweet this morning that shows, really the cause and effect nature of economics and really shows, the cycle that we're in here. It goes, inflation leads to shortages, shortages lead to austerity, austerity leads to recession, recession leads to stimulus, stimulus leads to inflation, inflation leads to shortages, and shortages lead to austerity. And it just, shows us this cyclical, crazy model that we're in. And, at what point do you think that this maybe flawed monetary theory that continues to produce this ridiculous cycle, at what point do you think it breaks?
I don't know what point it breaks, but I do know that what was probably a good idea at the time has become a crutch. And that's why these little problems of a little bit of inflation, a little bit of a shortage, right? Well, now it's a lot of inflation, a lot of shortage because we don't make anything. I mean, that's a general statement, but because we're not self-sufficient, and those are other points that I was trying to make. But I think what's happened is these little boom and bust things that I put in that tweet are the nature of the cycle being so much more exaggerated than it used to be is probably a function of the marketplace and the Federal Reserve behavior being too reliant on what works. If it ain't broke, don't fix it. And to answer your question, I don't know when they'll admit it's broke. Because it's broke by many statistical measures, 10, 20, 30, but it seems that, and this is like, I teach finance, as an adjunct professor. But this is going to be a slight to academics. It seems like that if you're in this bubble that academics and federal employees are in, you can't help, and I'm saying this like empathetically, although I probably wouldn't be so nice to them when I met them, you can't probably help but be completely ignorant of the grassroots swell problem. So we're in our own little bubble, and at least maybe you're not in it, but I'm in my own little bubble of the end of the world's coming, and I'm trying to not be end of the world, but usually for me and the middle, for the upper middle class, for the affluent, they see that it's breaking. For the middle class, it's breaking, but they're keeping faith. For the poor, it's like, it's broken, bail me out. It's broken, bail me out. And for these people in a bubble that say things like, I kid you not, it was, oh God, it just drove me nuts. It was so subtle, but it drove me nuts. But Powell said less than 2 weeks ago, he said during the whole little ECB conference where they did their next mea culpa coming out G7 thing, he said, households in general, are in very good, I'm almost quoting him, very good financial shape. And that's because they were given stimulus, they have banked that stimulus, and they haven't been spending it as much to travel, to do things like that. And I went, and then he said, to be fair, he said, and there are some problems, but in general. And I went, okay, I understand that. And then days later, you see reports that people's credit cards are maxed on zero hedge, which I contribute to. Your credit cards are maxed. People have no savings. I'm like, what chart is he looking at? Is he looking at his neighborhood chart? He's not looking at the public, or which could be worse, he's not ignorant and he is looking at it and he's just straightforward, full of crap, trotting out the ideology that keeps him in place. So my answer to your question is, as I'm working out loud, is I don't know if they admit that it's breaking until after it's broken. And after it's broken, then we get a reset, which is a very popular word now, but a reset in the less scary sense, it's scary, don't get me wrong, is Russia and China and the BRICS create some sort of, they seem to be intent on creating, and let's say they survive, right? They seem to be intent on creating some new commodity, some new currency that has a basket of commodities in it. And the US, which is excluding them from its trade, is toughing it out with inflation. And we've gotten the demand side down by the Fed doing what they're doing, but it's still too bad and it's becoming a chronic problem. And so we say, and this is where the Bretton Woods thing comes in, we say, we're going to create a Bretton Woods 3 thing in the West. And our Bretton Woods 3 product, which is probably going to be like an IMF type of product, is going to be swappable with your BRICS product. And then the world will go back to the way it was. And the people who suffer will be us. Because although we will still have inflation, but we're probably getting excuses for a central bank digital currency, which won't be tied to gold, which will be like Star Trek credits. I mean, I'm old enough to remember those. So I think a reset comes, and that's when it happens. But I think we, as paranoid as tinfoil hat as people like myself are on the right path this time. And there will have to be material changes, and they won't admit it until it's too late as far as we're concerned. So I don't know what breaks it, but it's breaking. It's broken. It's broken. It has to change.
Absolutely. There doesn't seem to be any doubt about that. And it seems to be just a matter of time before seeing the coyote actually fall off the cliff that he hasn't realized that he's run right off of yet, right?
Have you noticed that? If he doesn't look down, he doesn't fall. Right? It's kind of like the naked emperor.
Yeah, absolutely.
Like, just don't look. That's what the Fed's telling us. Don't look. It's fine. And if we look, we're going to fall. That's the best analogy I've heard to it. It's the coyote going off the cliff. As long as he doesn't look, he's fine. Yeah, it's true. I have a question for you. Since you know so much about this. Let's just hypothetically, and you can edit this out if you want, but I have a real question for you. What's the best case scenario? And I mean genuinely the best case scenario. The best case scenario is everything goes back to the way it was. I don't care how irrational it is. What makes everything go back to the way it was? Do you think? I mean, it's like you have to have world peace. You have to have us forgiving Russia pulling out, sanctions removed. Even if all those things, even if tomorrow, God came down and said, Russia's pulling out, Ukraine's going to be healed, there's no disaster, sanctions will be lifted, you still can't change the minds of the people. We don't trust them now, and they don't trust us. I'm not going to do trade with them for rubles. I mean, what makes it go back to the way it was? That's why I think it has to break.
I think there's a million pieces to that question. Just looking at it one step further back than that, let's just look at it from an energy standpoint.
Yeah.
If the world, not just we, if the world can't get the energy that it needs, if Europe can't get the energy that it needs, and I think a lot of these shortfalls are due to this ESG movement, maybe have been moved too quickly, however you feel about it, one way or the other. But in my opinion, I think we went to that being hawkish on the energy companies far too early before we had all kinds of alternatives in place. Without energy, there's going to be a lot of unhappy people, a lot of crops fail, a lot of shortages in different parts of the world. And I think that in some ways comes before being able to solve all of the economic and inflation problems, because I think the inflation problems are caused because of the lack of energy and the lack of food. And this is all due to short-sighted reactionary policies.
So even if we were to get, I'm just like extrapolating what you just said, even if we were to be able to go back to perfection, we'd actually have to have some geopolitical military problems like Sri Lanka, which is going on right now, or whatever's going to happen. It's kind of like the food crisis, a drought meets the Arab Spring. It's a disaster, but it's a global effect. Yeah, we might have to go lower before we go higher.
And even if let's just say we put the Band-Aid over the Russia-Ukraine situation,
right?
But there's still a whole other piece of the puzzle that has been in some ways damaged beyond repair that affects the stability of the rest of the pyramid or the rest of the Jenga tower in some ways, right? And I tweeted that story about Sri Lanka the other day, taking out, let's say, the idea of organic farming, how you feel about that. Right. But the idea that they mandated organic farming having to be, on this date, we're going all organic. And then their crop yields fell by something, I think it was at least 25%. And now you have all kinds of people starving. Again, look at this from an economic standpoint of there's always going to be a trade-off. And if you don't consider those ramifications, you're going to put a lot of people through a lot of pain that could have been avoided.
That's actually very true. I guess the mandates, to the extent that we try to mandate something like that or try and make people do it, it's like a comment on the confidence, which becomes hubris or arrogance in our ability to control things. As you were saying that, it reminded me of something. I mean, it's a name drop, but I don't know the guy. The trader Victor Niederhofer, he's been around forever. He was, he was Soros's trader. Well, I had dinner with him we both had the same attorney, and I had dinner with him, and he made a statement. We were talking about, he was saying, "What do you read, Mr. Niederhofer?" I was like a student. I'm like, I was reading Wall Street Journal. I read the National Enquirer. I'm like, why? Because all that other stuff is a lie. And I'm like, well, what do you mean? And we were talking about silver, of course. And I talk about silver, and he brings up the price of candelabras. And this is like where he was. The price of candelabras during the Black Plague. And I'm like, okay. What are you talking about? What I'm getting at is he made a statement. He said, and it might not have been him saying it, but he was quoting someone. He said, all global famine is man-made. It's from governments or people or warlords or intermediaries getting in between the food and where it has to go. Mm-hmm. And it's man-made. And on the heels of that, he said something like, did you know a 5% shortfall in crop yield translates to a 20% increase in price? I'm like, no, I didn't know. This is before they had really, really efficient thing. I didn't know. It was like 2003 we did it. And he goes, there's a multiplier effect. A 5% shortfall in wheat that's not replaced anywhere becomes 20% at the pump, so to speak, in the grocery store. So you're talking about 25%, which we could probably stomach in one country. But because of no energy, which is what you said, right? Because fertilizer is more expensive or harder to get, then you're going to have drops in crop yields. You got mandates. So it's not one country, it's every country. So food prices should go up 40 to 100%. So yeah, I mean, that's right. Anyway,
and that was one piece of the puzzle, right? And that's the thing is, that's right. Why I love having the ability to have conversations like this and bounce ideas back and forth, because it's hard to be able to keep your eye on so many of these balls or all of these puzzle pieces, whatever analogy you want to use, that all of these problems have compounding effects.
Yes, that's it. I mean, you're comment about pointed pieces of the puzzle. Yeah, the crop yield has failed, but why is the crop yield failed? Is it because of a bug or a boll weevil or a season? Well, no, it's because we can't grow it, and it's not just us, it's everyone. And
because somebody told us we can't.
Yeah, so exactly. That's the other part. Somebody told us we can't. and somebody told them over there that they can't use oil. So, I mean, it's a disaster. It's basically we're protecting Mother Earth by killing ourselves, But let's be honest. I mean, Mother Earth is not a very happy mother. I mean, oil was made from dinosaurs, so she basically killed a whole generation of animals to give us oil. So I'm not so thrilled with Mother Earth these days. But yeah, it's
maybe that gives us better perspective for which we should be grateful for being able to enjoy some souls of dinosaurs, I guess, right?
Give a hoot and pollute or something like that. But yeah.
Well, Vince, I think that's a good place to wrap up today's conversation. Of course, you're an excellent follow on Twitter at @VLanci Pictures, and your Substack is full of excellent information, which is new since the last time we spoke, right?
Yes. I've that's been going on since, when I started it right after our Basel III conversation.
Oh, excellent.
I went, this needs to be written about. And so I just started writing a lot about it. And Twitter, I'm an acquired taste. Just be careful of that. It's peppered with things that don't really make sense. So, I appreciate you mentioning that. But it's great to be here. And I look forward to coming back. Maybe with Keith, we can talk about how wrong he is about backwardation, or how right he is. Who knows?
Well, it's always a good convo to look forward to, Vince. Thanks so much for your time today.
Thanks for having me, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.